Everybody, thank you for joining us today for our weekly webinar. Before we get started with some real quick announcements and an introduction, we have a real quick video for you, and I'm going to let Juan cue that up and take it away.
My goodness, another downturn for the stock market. How on earth am I going to make money and retire at this rate? There has to be another way to invest my money safely.
There is.
Who said that?
The disembodied voice in your kitchen.
Oh my! Wait, what other way is there?
It's something called a self-directed IRA.
A self-directed IRA?
Yes.
Well, what does it do then, huh?
A self-directed IRA allows you to use your 401k and IRA money to invest in alternative assets such as real estate, notes, and private entities. With self-directed IRAs, you can take control and diversify with alternative investments that you're knowledgeable about, without the uncertainty and fluctuation of the stock market.
Well, that sounds like a swell idea. How do I get one of those?
All you have to do to get started is open up an IRA with Quest Trust Company. You can speak to one of our certified IRA specialists and submit an application in just a few minutes.
How grand! I think I'll call them right now.
But wait, there's more.
There's more.
Don't get burned by the stock market. When you open up an account with Quest Trust Company, we'll send you a free toaster. That's right. When you open an account right now at Quest Trust Company, we'll give you a free toaster. All you have to do is use promo code TOASTER and call 1-855-FUN-IRAs or send us an email.
Alrighty, so as you can see, we're doing a real fun promo right now. If you open an account, you will get a toaster, kind of paying homage to how they used to do those promotions back in the day. That's our fun little take on it. So real quick, I'm gonna go ahead and just give a couple of brief announcements real quick. Can you guys see my screen? We all good to go? Let's see here. Alrighty, so real quick, thank you guys for joining us. Who are we? Who is Quest? So we are the largest self-directed IRA custodian in Texas. We have over 20,000 active investor clients.
Sorry to interrupt, but could you just change your display settings?
Yeah.
Here you go.
Can you see it now?
Yep, you're good.
Perfect. We monitor over $2 billion in assets under administration, and we have over 100 employees with now about 35 certified IRA services professionals. So if you ever have questions or are looking for an educated staff member, there's definitely somebody that can get you squared away, whether that is self-directed IRA basics or transaction questions. We definitely have the knowledge base to get you taken care of. But of course, like this class and all of the other education that we do provide, it is strictly for educational purposes only. So Quest does not give any tax, legal, or investment advice. If you do require some sort of knowledge from a higher level, we do ask that you seek a tax attorney, CPA, or financial advisor. So some new things that we have here at Quest is our new and improved QTC client portal. If you haven't experienced the client portal, we definitely would love for you to go on, get logged in, see what's new there. But you have a lot of brand new features for you that you didn't have in the past. So we've added a lot of expense pay features, the ability to now submit new investments online, open up accounts online. You can always go there and find helpful updates and messages that we've sent from Quest. But again, also the Education Center has been revamped as well. So it's pretty much your one-stop shop to get everything taken care of all online. Same fast processing times as always. But if again you ever need questions answered, we can definitely help you out and explain more about that client portal. Like this class, Quest offers endless education. So from our YouTube page, you can find tutorial videos, On our website, there are helpful videos and blogs, archived classes that we've done in the past, but also the calendar of all of our upcoming weekly webinars. So every Tuesday and Thursday at 12 p.m., just like right now, we have our weekly webinar. And then also on Saturday at the same time, we call it our Self-Directed IRA Saturday. But these are really great places to come and get some education about how to invest with the Self-Directed IRA, but also network with other people that are online as well. But if you are looking for more networking, we do have our virtual networking happy hour, which is designed strictly for you guys to come network with other investors. If you have a deal or a service, you can pitch those. And it's a really great place for people to really come together. And if they're really looking to find a deal, to make those connections here, maybe with people that they wouldn't have the opportunity to in person. Our next big upcoming event is the Quest Summer Intensive. So this is going to actually be starting tomorrow, but it's going to be taking place consecutively over the next 3 Fridays. So tickets for this event are $25, but what this one is really designed to do is be more in-depth, more detailed knowledge about all sorts of alternative assets that you can invest with your self-directed IRA. So multifamily, performing, non-performing notes. We're doing commercial and single family real estate, oil and gas. Honestly, the list goes on and on. But this is going to be really more of a high level type of class as opposed to just some of our weekly webinars that we do. And then last but not least for the events, we are coming back to live in-person classes and events. So I know that that's something that we've all been itching to do, is really get back out there. And we're excited to let you guys know that it is happening. So all across our offices in Houston, Austin, and in Dallas, we're going to be throwing a big grand opening white linen party. So come wear your nice white outfits, network with us. We want to welcome you back into our offices while we start kicking off our new classes that are going to be happening in August as well. So as you saw at the beginning of the class, we played that toaster video promotion for you. And along with that, we do have our main July promo that's going on right now for this whole quarter. So when you open your account and you move over, either roll over or transfer funds into your account, we will actually give you account credits back. And you have the opportunity to earn up to $500 for doing that. So to get this, all you need to do is use the promo code REWARDS21 on your application, and you'll be able to get that promotion. And of course, along with the toaster as well, doesn't hurt. But if you refer people as well, you'll also be able to earn account credits. And this is not limited to 1 or 2 referrals. You can do this an unlimited amount of time and continue to earn account credits for every person that you refer. So if you want to get in touch with us or want some more information about the promos or the events that I have talked about today, feel free to contact us by scanning that QR code, emailing us, or giving us a call. But also you can utilize the chat box feature on our website as well. There's always a live person on there. You won't be talking to a robot, I promise. And we'll be able to get you squared away for whatever you need. But without further ado, I'm going to go ahead and just introduce real quickly our speaker today. So we have Domonic Purviance, who is an expert and senior financial specialist with the Federal Reserve Bank of Atlanta and focusing in the supervision, regulation, the credit division departments. But with his main responsibility is really studying residential real estate markets and predicting those trends so that you guys are prepared for what you are planning to do investing wise. So Domonic, thank you so much for being here with us. If you are ready to take it away, it's all yours.
All right, thank you. Can you guys hear me okay?
We sure can.
Right, so my name is Domonic Purviance. I'm a subject matter expert at the Federal Reserve Bank of Atlanta. My main responsibility is at the Federal Reserve is to be responsible for developing the residential real estate analytics that supports our banking supervision function at the Atlanta Fed. Also relied upon to provide some expertise and support to other Federal Reserve districts throughout the system. And I do a fair amount of outreach events like this one, where we share some of the insights and research and analytics that we're doing internally at the Federal Reserve with the general public. Just a few disclaimers before we get started. I do have to say that my views do not necessarily represent the views of the Federal Reserve or the Board of Governors. Also, that the Federal Reserve doesn't publicly endorse any private company or services. With that in mind, I'll go ahead and share my screen, and you should be able to see the presentation in front of you. All right. So just a little bit of backstory before I begin. You know, we about a year, several years ago, we started internally tracking housing affordability, which is to us a leading indicator of the overall health. Not only the health, but where the housing market is in its cycle. Typically, when housing gets to the point where it's unaffordable, that's normally the early sign that the market is about to cycle. And so we've been tracking it internally down to zip code level in some cases. And we decided about a year ago at the onset of the pandemic, incidentally, to release a publicly available tool that allows the public to have some access to the information we have as relates to housing affordability. A little later in the presentation, I'll drop a link to our public available tool in the chat, and you guys can take a look at it. And it goes down, it's updated monthly at the national MSA and county level. So you're able to, at a monthly rate, monthly pace, look at what affordability trends are like in MSAs down to the county level. So it's a pretty useful tool. We've had a lot of traction and some public press paying attention to that tool, and hopefully it'll be a resource for you to use as well. So this is a little bit of an overview of what I would like to talk about today. I am going to give a brief overview of where we are kind of in the economic cycle post-COVID. I'll focus specifically on mortgage rates because over the past year, that's been a predominant driver of the talk about the impact that that's had on demand and in addition to supply in terms of the inventory levels. And then we'll dive into what's been the current trend in home prices, which is no surprise, and most people are aware that home prices have increased pretty sharply, and in some cases at historic levels, mostly because of this sharp decline in inventory that we're seeing. And that's had a direct impact on affordability and a future impact on where demand is going moving forward. So just a brief overview of where we are in terms of the economy. Now, this is as of the April or May. I think this is April job numbers. So we lost about 20 million jobs last year in April, which was the largest contraction in jobs that hopefully we'll ever see in our lifetime. We gained over the past year about 14 million of those jobs back. So that means that we're sort of at a deficit of around 5 to 6 million jobs. A lot of those jobs are people that were in, we'll talk about in a second, service sector industries, and the low income, and those jobs tend to be low wage jobs. They were more adversely impacted. It's taken a little bit longer for those jobs to come back for a variety of reasons. But in spite of the pretty significant contraction in the economy, there's certain segments of the economy that actually did fairly well. One of which is of course the housing market. So this is GDP growth. This is GDP growth broken down by its components. I want to pay close attention to the teal colored part of the GDP growth, which is here. This is personal consumption. So that's primarily consumer spending. Consumer spending is, for the most part, the largest share historically of the U.S. economy. You can see at the beginning of the pandemic a large contraction in consumer spending. Second quarter of last year, followed by a pretty sharp bounce back in consumer spending. What the numbers don't reflect is where consumers were spending during the pandemic versus where they were not spending. So a lot of service sector jobs on travel and tourism and restaurants. There was a cutback in spending on those areas, but a lot of online resources and other things related to people adjusting to living and doing work at home, seeing an acceleration in spending. And you can see how things have sort of balanced out the fourth quarter of last year and the first quarter of this year. I would say I don't have a chart in here about inflation, but I'll talk briefly about it as it's been a topic in the news lately. I know that the chairman just spoke yesterday and fielded some questions. I'll leave some of the comment, some of the more in-depth discussion about the Fed's thoughts on inflation. I will refer you to some of his comments and some of the statements, the public statements released by the FOMC. But the Fed's position is that we do expect to see some level of inflation, but the level of inflation we'll see is more transitory, meaning that it's a bounce back from of demand in sectors that were more adversely impacted by the pandemic. As the economy opens up, demand accelerates for things like travel and tourism, but of course the capacity to meet the demand is still behind, so that causes some level of inflation. And so when capacity, increases to the level that it can meet the level of demand, then you'll start to see the inflationary pressure wane a little bit. So that's generally why a lot of economists in the Fed and outside of the Fed believe that the level of inflation that we're seeing now is a result of bounce back in demand not met by capacity. But once capacity recovers, then you'll see the level of inflation wane a little bit. So that's pretty much why it's seen as transitory. And so that has reason why that's relevant. That has some implications on monetary policy and how what the Fed sees as the trigger for either raising rates or lower rates or leaving rates the same. As the Chairman Powell mentioned, I believe on yesterday, we have a dual mandate: inflation and employment. As long as employment, as this chart suggests, as long as we're not back at full employment, we still are focused on making sure that the employment is back to levels prior to the pandemic, and because inflationary pressure is seen as more transitory, it will keep the status quo in monetary policy. All right. So I mentioned a second ago about the different sectors that were more adversely impacted. You can see the high wage sectors, people who make an annual income of $60,000 or more, saw a 2% reduction in employment over the past year since the beginning of the pandemic. People who make between $27,000 and $60,000 saw 8.1% reduction in employment. The low wage sectors below $27,000 saw a cut of 30%. And you're seeing through the middle of last year, those jobs recover, and then through the beginning of this year, we see a little bit of a lag. So those sectors, the low wage sectors, are still adversely impacted. We do expect them to recover as the economy begins to open. But these are the people that were more adversely impacted, and it shows up here when you start looking at employment by sector. These are the sectors that lost, pretty much every sector lost jobs at April of last year. None more adversely than leisure and hospitality, which lost about 7 million jobs, which is, certainly extraordinary. Trade, transportation, and utilities also lost a significant amount of jobs, about half as much as leisure, about 3 million jobs. And again, those are, related to travel and airport and airline workers, and jobs like that. Other sectors, professional business services, education, health. There are a lot of schools that shut down. So you see the numbers there. Fast forward a year, you can see that most sectors were either flat or started to gain jobs. You can see leisure and hospitality, adding a significant amount of jobs for the month of April. But again, there's a long way to go before all of those jobs are fully recovered. I would say that, one thing to note is because this recession impact low wage workers, these are people who make less than $27,000 a year, aren't necessarily the people that are the households that are most viable to purchase a new house. Which is one of the reasons why home sales have not been adversely impacted at all as a result of the job losses. In fact, home sales accelerated quite a big deal. All right. So talking about mortgage delinquencies, this is one of the surprises here. So I have the blue line here is the overall U.S. The red line is the 6th district where the Atlanta Fed is located. So that would include most of the Southeast. So that's Georgia, Florida, Alabama, parts of Mississippi, Louisiana, and Tennessee. So this would not include Texas. But in general, there were more, the level of delinquencies were much higher here in the 6th district than the overall nation. It peaked at 11%, where the overall nation peaked at 9.2%. You think about it, areas that are more heavily concentrated in leisure and hospitality and tourism, transportation and trade are the ones that saw a higher rate of delinquency. So for example, our district has Florida with Orlando and Miami, heavy, in other parts of Florida, heavy tourist and leisure and hospitality destinations. So those markets saw a higher rate of delinquency than other markets. Both have declined. We expect to see a continued decline as a lot of mortgages that are forbearance start remitting payments. There is some concern that when the forbearance and moratoriums end, that you'll see a flood of foreclosures. I am not as concerned about that. There is increased interest for at least the institutions that we talk to work with borrowers to make sure that their payments are modified to the point that they'll be able to make payments, and those loans that are delinquent will cure. Even if there is a flood of foreclosures in certain submarkets, again, those markets that were more adversely impacted by the pandemic that have not recovered or would not have recovered by the time the moratoriums or forbearances programs expire. Because the market is so undersupplied, it may not have as much of adverse impact on home prices as we've seen in previous cycles. And I'll talk more about that a little bit later. All right, so as of June 17, the 30-year fixed mortgage interest rate was 2.93. I looked at the more recent numbers and I don't remember if it's higher or lower. It's plus or minus 3%. and which is still historically low. The low interest rates were a response to the pandemic, and that caused a surge in mortgage originations, and both finance and refinance and purchase origination activity. As rates have inched up since the rates troughed at the beginning of this year, rates have started to inch back up. It has caused a contraction in mortgage origination activity. I would suggest that there is a bigger reason why we're seeing a contraction in activity that's less to do with rates and more to do with home prices, which we'll talk about in a second. All right, so this is the trend in mortgage rates going back to 1972. So we are at still historic low 30-year fixed interest rates. You can see the kind of the pull-out window at the top here. You see, we were in January of 2019, we were at 4.5%, which actually was an uptick in interest rates from previous years, and that caused a pretty significant contraction in housing demand back, if you remember, end of 2018 into 2019. We've troughed. This is a historic low in January of this year at 2.7% and 30-year fixed interest rate. Very low, very favorable. That was the primary impetus for demand for mortgage originations all throughout last year. And we saw a little bit of a spike through the first quarter of this year. And then in June, the rates have started to come back down. But that spike was enough to cause demand to slow a little bit. But it wasn't rates alone. It was a combination of higher rates and higher home prices that caused a little bit of a slowdown. All right. So here's the chart on the left is refi activity. The chart on the right is purchase mortgage activity. The bars here are the year-over-year change in growth. The line in the chart here is just the 30-year fixed interest rate. So you can see both. Yes, one of the drawbacks of doing presentations at home is you got some background noise that gives some competition. So apparently I live near a train. So in the chart on the left, you see. All right, so I think the train has passed. All right. So can you guys hear me okay?
We sure can.
Okay, great. All right, so you can see the chart on the left. You can see the as rates declined at the beginning of this year, we saw a tremendous spike in refi activity. As I mentioned, as rates start to climb a little bit, you saw a contraction in refi activity going into the second quarter of this year. In terms of purchase mortgage activity, the same thing. You saw the contraction, the decline in 30-year fixed rates, which actually started before the pandemic, but sort of accelerated during. This contraction in purchase activity was in April of last year, which was kind of the beginning of the pandemic, and you can see the recovery in demand throughout the rest of the year. This spike in April of this year is just sort of you kind of pay attention to the kind of year-over-year comparison. So you're comparing April of this year to April of last year. It makes it look like it's more of a spike than it actually is. So the increase in demand for real estate in general was not met with an increase in supply. And so if you look at, according to National Association of Realtors, inventory declined by 20% in March of this year, and inventories continued to not keep pace with demand. And there's several reasons for this. So low interest rates is a positive if you want to have some kind of temporary increase in mortgage originations. However, it does mean that people who refinance their mortgages have a disincentive to now put their house on the market. So anytime we see a spike in refi activity because rates are very low, it means that there's fewer homes that are available to sell. The other thing that's happened is a lot of people are making the decision to not put their home on the market because as home prices increase, even though rates are very low, people are making a calculation that if they sell their house, they'll have to buy a new house somewhere, and it will, significantly increase their housing costs. And so they're electing to refi or do cash out refis, take the money and pay off debts or make investments elsewhere, not necessarily to put their house on the market. And the last thing that's happened, of course, last year is a lot of people, due to social distancing requirements, have decided not to put their house on the market at a time when lower interest rates cause a spike in demand. So thus, you have a pretty severe contraction in inventory, and inventory levels are at extremely low levels. Inventory is at extremely low levels, which I'll show in a second. The other thing that's happened is, new home construction capacity has not kept pace with pre-pandemic levels. And that's led to some pretty strong cost escalation, particularly in lumber, which I'll talk about in some more detail. But essentially, lumber factories, processing factories sort of shut down or operated at less capacity at the beginning of the pandemic at a time when demand was very high. That caused lumber prices to spike, in addition to a spike in labor costs. So altogether, the new home prices have experienced significant upward pressure because of limited capacity. Now, we have seen starts increase, but they still are not able to keep pace with current level of demand. So I mentioned inventory. So this chart is probably the most important chart I believe in the presentation, because it illustrates really what I think are the dominant factors impacting the housing market. So the bars here in this chart are the total level of existing home inventory. So new home inventory is not included here in the market. The line here is the month supply of inventory. So this tracks how many months it would take to sell the current amount of inventory given the current rate of absorption. And so I have indicated here anything above 4 months or below 6 months is considered balanced. That means that, the supply equals demand, and you see some moderate price appreciation when the month supply is between 4 to 6 months. Anytime the supplies are the month supply is greater than 6 months, that's considered an oversupply. So you can see where we've been historically. I like to point out that at the height of the previous housing boom in 2004, the month supply at its lowest was just at 4 months. If you look at where we are today, we've been teetering ever since 2017 with plus or minus 4 months of supply. Since the pandemic, we've experienced a sharp contraction in inventory. At the trough, the month supply of inventory dropped to below 2 months of supply. And I can't tell you just how significant that is. When inventory is below 4 months of supply, you see upward pressure. When it gets below 2 months of supply nationally, that's a pretty significant supply shortage. And the strong upward pressure on home prices that you're seeing in the market is a direct correlation to the shortage of inventory. All right, I mentioned lumber. Lumber costs peaked at about $1,600 per 1,000 board feet. And then what's normal, preference, lumber cost per 1,000 board feet between 2015 to 2019 averaged somewhere about $400. It peaked to $1,600 last year, according to the report by the New York Times. We have the response by home builders was to limit sales in order to get ahead of cost. And so if you see new home sales contract, it's not because there's a lack of demand, it's because builders intentionally limited how many homes they would sell so that they wouldn't get ahead of cost, so they can stay ahead of costs instead of, putting a house under contract. And then once you go to build it, your costs have increased significantly and you have to, bake in some kind of escalation clauses for your buyers. So currently lumber is down to about $900 per board feet, per 1,000 board feet. And that's still above what's considered normal, but it's a little bit it's off significantly from the peak. And that's been a direct byproduct of the response from home builders, limiting sales. So in terms of starts, builders have accelerated the rate of housing starts. Starts are up 12.9% year over year, which is pretty good, and that's a response to units that are under contract. Still, even with the acceleration of housing starts, it has not been enough to keep pace with the level of demand, which is pretty telling. At the same time that housing starts have increased, the level of lot inventory has not kept pace. So starts are up 12%. This is vacant developed lots. This is lots that the curbs are in, the utilities are there, the streets are paved. There's no vertical construction. So that you see the sharp decline there, down 10.4%. So again, the lack of capacity to keep pace with demand means that lot prices experience upward pressure, and that upward pressure and lot cost is shifted onto the consumer. Now, the consumer has been able to absorb that because of low rates, but that's starting to change as we'll see in a second. So nationally, in terms of where vacant developed lots are located, so they're all in Texas, apparently. Everything in green is a market that has at least 20,000 vacant developed lots or more. You can see there's a concentration in Texas with Dallas, Austin, San Antonio, and Houston comprising the majority of housing starts in the country. So the reason why you're seeing pretty sharp increases in housing activity in Texas is because that's where most of the vacant developed lots are. Outside of Texas, of course, there's Phoenix. Chicago has a lot of legacy lots. You can see up here in Illinois. You see Phoenix here. Atlanta, where I am, of course, has more lots than any market in the country. I think we have around 50 to 60,000 vacant developed lots here in Atlanta, and that's pretty much more than any other region alone. Florida also has a lot of smaller metro areas that combine give Florida a significant amount of lots. So all of the activity you're seeing is concentrated in places like Texas and Georgia and Florida. All right. So in terms of home prices, so all of the factors we mentioned before has added this upward pressure in home prices. So there's a distinction between price appreciation and median home prices. And so I'm sort of going to get in the weeds a little bit here. So home price appreciation, this is the value of existing homes year over year, according to CoreLogic, was up in April by 14.7%. Now, that is if you look at the value of a home 1 year, and the same value over the next year, how much has the value appreciated? That's what the CoreLogic HBI Home Price Index is tracking. Now, many of you have heard the National Association of Realtors number indicating that the median home price increased by 23.6%, which is the highest ever. Our numbers show something very similar when you talk about the median home price. But remember, the median home price is looking at the price of homes that have sold on the market from 1 year compared to the price of homes, the median price of homes that are sold on the market for the next year. So if you're just looking at the price of homes that have sold, you're going to see a bigger increase than if you're looking at just the value of homes that currently based on a home price appreciation. So it's a little bit confusing. Both numbers tell the same story essentially, and it's that we're seeing either home values and home prices increase pretty significantly. So again, this is HPI. We're only talking about home price appreciation. So if you are in your home today and you are trying to determine how much the value of your home has increased over the past year, this is what this number here that we're showing is indicating. So 14.7% increase year over year. You have to go back to 2005, 2006 to see something similar, kind of a high double-digit increase. The more recent numbers that I've seen, this chart is a little outdated. It's just only seen a continuation of that trend. The big thing here is just look at the exponential increase in home price appreciation over the past several years. Again, that's a direct correlation to the lack of inventory. In terms of metro areas, what we're seeing, the majority of metro areas, about 60% of all metro areas in the country have double-digit appreciation. That's the green shaded chart, part of the chart here. Only about 13% of metro areas in the country have seen a decline in home price appreciation. In terms of which areas have seen the most, Phoenix, and I'm only looking at kind of the larger MSAs here. So MSAs with a little bit larger populations are included in this chart. So Phoenix with 18.3% has experienced the sharpest price appreciation, followed by Austin with 14.4%, Seattle with 13.3%. You see a couple markets in our district, in the 6th district, Jacksonville, Tampa, and Nashville kind of round out the top 10 there. You see Dallas here as well in Texas. So the normal players, I mean, these markets from Phoenix, certainly Phoenix, Austin, Jacksonville, Tampa, Nashville, Charlotte, Denver, and Dallas. These are markets where people are moving from high cost markets like New York, New Jersey, Chicago, California, and they're moving to a market like Austin or Phoenix or Jacksonville. Those are the markets that are seeing a pretty strong price appreciation. The older markets, like you see down here at the bottom, San Francisco home prices were flat. New York and Chicago, you've seen kind of flat price appreciation. Houston here not seeing it as strong as a price appreciation as a market like Austin and Dallas in Texas. In terms of existing home prices versus new home prices, you can see both are at peak levels. The more recent numbers that I've seen only have seen an acceleration of this trend. So back here in April, the existing median home price was up to $325,000. This is on a 3-month moving average. So we use a 3-month moving average to sort of smooth out the numbers. So if you just look at the raw numbers, they're going to be much higher than this. So these are a little bit conservative. New home prices up to about $345,000. All right. So what's sort of the net effect of this? How does this look if you're in a particular market? So I have Nashville here on this chart, and this is July of 2005. If you know anything about Nashville, the city of Nashville is located here in Davidson County, kind of southern part of Davidson County, into Williamson County. Williamson County is kind of a high-end segment in Dallas, in Nashville. And so everything in orange in this chart is a metro area that is a zip code within in Nashville that has a median home price of $250,000 and greater. Everything in green is below $250,000. You can see the chart on the right here just shows the overall metro area. In 2015, on average, the median price of a home in Nashville was just under $250,000. So if you fast forward just in 6 years, you see how dramatic of a change the market has experienced. So you can see a lot more orange. So all of Williamson and most of Davidson and into Wilson County are orange. That may not mean anything if you don't know anything about Dallas, but just the difference between 2015 and 2016 and 2021 is really what I'm getting at here. You can see we had in 2015, the median home price was just under 250. Now you can see it's just about 400,000, and that's just in 6 years. We've seen this big of an increase. So this is the same thing with the city of Atlanta. You can see the orange here is above 250. You can see the green is below. In 2015, you pretty much could find most zip codes in the region. You could find affordably priced housing, meaning housing below 250. You see, on average, the median home price in Atlanta was about 230. Fast forward 6 years, you can see a big swath of the market is all orange here, means the median home price is above 250. The median home price for the region is about $340,000. All right, if you talk about new homes, so this is a distribution of new home starts by price point in 2011. So about 10 years ago, the majority of the starts were below 300,000. So 33% is 300 and above. And that means, 77% is below $300,000. This is new home starts nationally. This is where we are today. As of the end of first quarter of this year, about 70% of all new home starts are above 300,000. What this means is that new homes they're back in just 10 years ago, you could deliver what's considered an entry-level starter home product, less than $250,000. If you were making the median income or below the median income, you could afford to buy a new house. Today, new homes are more of a luxury product, meaning that if you make, below the median income, you most likely are not going to find an affordable new home product, much less you may not even be able to find an affordable existing home product, given how fast home prices have increased. So I do have a chart of Dallas here. So you can see Dallas, this is new home construction this is 2005. Everything in green is a zip code that has a significant level of new home starts below $250,000. You can see the chart on the right just shows the distribution of new home starts in the entire region. 30,000 new home starts were below 200,000 in 2005. So the clear majority of the product in Dallas was considered entry-level starter home product. It's one of the reasons why markets like Dallas and Austin and Houston and San Antonio attracted people from high-cost markets, because it was much more affordable. That's still the case today, relatively speaking. But if you fast forward to where we are today, you pretty much can't deliver new home product below $250,000. Really, the floor is somewhere around $300,000 for a new home product on newly developed lots, I should say. There's some legacy lots that still allow you to deliver affordable product, but that's greatly diminishing. All right. So the other thing that we're seeing is a pretty significant increase in cash sales. And so in April of last year, 15% of all sales were cash, whereas in April of this year was 25%, so a 10% increase in cash sales. Part of this has to do with, so this is all cash sales, so a lot of people are paying cash today. The reason for it is if you're in a high-cost market like New York or California, you have a lot of equity in your house. You're able to sell your house, cash out, and go buy a house and pay cash in a market like Dallas or Austin. At the same time, there are a significant amount of people, they may not pay all cash, but they bring a significant amount of cash to the closing, which means that they can pay above the asking price, or they can make the difference. They can make up the difference between the appraised value and the sales value if there is a difference. And so how that plays out, if you look at some data points, so this is Zillow, this shows the share of homes with a price cut. You see some seasonality here where in the peak selling seasons, there's fewer homes, they get a price cut, and the fall and the late summer, early fall, there's fewer homes, they get a price cut. So it's about between 12 and 18% of homes sold on Zillow got some kind of price cut. You saw that slow down in 2020. The beginning of this year, it bottomed out at less than 8% of all homes sold actually sold with a price cut, which means that if you put a house on the market, you pretty much are getting your asking price, or as we'll see in a second, above asking price. So this is sales to list price. This is using Redfin data. This looks to me to be a little bit exaggerated, if I could use that term, but I think that the sentiment is true, where, I mean, when you talk to agents, you hear a lot of people are just getting well above asking prices. So if you're getting 102% of the sales to list price, what this means is on average, the homes are selling for 2% above asking price. That's not too far-fetched to believe, given some of the things we're hearing in the market. I also mentioned cash out refis. So this shows the kind of in the billions what people are doing when they refi, how many people are pulling cash out and for either paying off bills and making other kind of investments. So you can see we're not as high as where we were in 2006, where it was about over $100 billion, but we do see it increasing. A little bit of a concern if people are cashing out now, if home prices are sort of at a peak, and if we see a decline in home prices, which I don't suspect we'll see, you may be a little bit underwater. As I also mentioned, we're seeing a lot of people move from high-cost states to low-cost states. You see California, New York, Ohio, Illinois. These are places where people are moving out of. You can see that's the number one state in the country in terms of in-migration. This isn't total numbers, it's just kind of a share here, is Idaho. You will see a second, Boise City, Idaho is one of the markets that's experienced the sharpest decline in price appreciation, sharpest decline in home housing affordability, mostly because people moving from California, moving to Boise City. All right. So as a result of all of that, we've seen a 7.4% decline in housing affordability using our index, which I'll share with you in just a second. 82% of all metro areas in the country have experienced a decline in housing affordability, even though interest rates are very low. So this is our index. We call the Home Ownership Affordability Monitor. It tracks what the median income household could afford, given the current median home price, current interest rates, taxes, insurance, and other things that we track in our index. Anything above 100 is considered affordable. Anything below 100 is considered unaffordable. Essentially, this affordability threshold is at 30%. So if you pay more than 30% of your income, your annual income on housing, housing is unaffordable. If you pay less than 30% of your income, then housing is considered affordable. So essentially, nationally, believe that the median income household would pay greater than 30% of their annual income on housing. So nationally, the U.S. housing market is considered unaffordable according to our index. The driver of affordability, is unaffordable. The decline in affordability has been home prices. So green is income, the red is interest rates, blue is home prices. So you can see the home prices is a drag on affordability. offsetting any benefit we get from higher wage growth and lower interest rates. This map shows the change in affordability for metro areas. This is in April of 2020. Because rates were dropping at the beginning of last year, mostly every market in the country experienced some boost in housing affordability, which actually led to increase in demand, Fast forward to April of this year, 82% of all metro areas experienced a decline in affordability. So every orange market is a market that experienced a decline in affordability. In terms of which markets have experienced the biggest decline, the table on the right shows the markets that experienced a contraction in affordability. As I mentioned, Boise City, Idaho, 17% decline in housing affordability over the last year is primarily a byproduct of people moving from high cost markets, kind of pricing out local buyers and dramatically increasing home prices. All right. Finally, the impact on demand. The more recent numbers has only seen this accelerated. So the year-over-year decline in home sales in April declined by 2.7%. Home sale, I believe the most recent number in May is the home sales are flat, but a lot of that has to do with the decline in housing affordability. You can see here, this is the top line here is sales, the bottom line here's inventory. We talked about inventory. You can see the sales declined in April of last year and bounced back and kind of at peak levels. We're starting to see sales decline overall because there's just a lack of affordability. All right. So some conclusions, and if we have time, we'll open it up for some questions. Housing market has experienced a robust recovery, but it has not been met by an increase in inventory. And so that's led to some steady upward pressure on home prices, which is starting to lead to a decline in affordability. And we just updated our index yesterday. And so I haven't had a chance to post it. We'll probably post it later today. And you'll see home prices have only increased even more, and affordability has contracted to very low levels. And so we're starting to see buyers in the market hit the pause button because prices are getting to become very unaffordable. With that, I will turn it back over to our host, and if we have time, take some questions.
Awesome. Thank you so much for that great presentation. I know I personally learned a lot. We do have a couple of questions, and also if you do have questions for Domonic, definitely feel free to send those into the Q&A box now. But a couple of questions that we have, and you might have answered this, but what are some of the potential risks that you're seeing, and how they will what are some of those potential risks and the impacts that they will have for the current market here in Texas?
I do think that affordability, the lack of affordability, is the primary risk that is sort of the leading indicator of where we are in the housing cycle. And what happens is people get a little bit overextended and borrowing, and we may be lending on collateral that is overvalued. And so, we do run the risk of people being a little bit upside down on their mortgages should we see a contraction in home prices. I will say, because inventory is so low, even if you see a slowdown in demand, or if you see an increase in foreclosures come on the market, it will not have a significant impact on prices, simply because the market is so undersupplied. But if I had to pick one risk, I would think that it's sort of the housing market is a little bit overpriced. People may get somewhat overextended in borrowing as well as lending on the banking side.
Okay, thank you. Another question we have is, are there any particular asset classes that you view as being more recession resistant than others?
Yeah, I would not say that there's any particular asset classes that would not be resistant to recessions. I remember in most of anyone that was involved in real estate back in 2006, remember people said, well, the housing market will never decline, that home values will never decrease, and that the housing market is resistant to recessions. Well, that didn't happen. And you know, I do think that certain asset classes may be resistant to certain types of recessions, but you're never for sure if you will see some unprecedented contractions in the housing market in certain areas, not the housing market, but the market in certain areas that will impact asset classes that tend to be resistant. And so I would not say that any asset class is impervious to recessionary conditions, even though it may take some unprecedented conditions to cause recessions for certain classes.
Right. Yeah, definitely. We also just got a question from Mr. James Woods. He said, when do you see pricing moderating? Or when do you see pricing moderating?
Yeah, so in order for prices to moderate, you'll have to see an increase in inventory. And we're starting to see that now. So, what happens is that a seller puts their house on the market because their neighbor got, 400, so they think they can get 420. So after a while, their house isn't selling, so they'll start lowering the price. It takes a while for buyers to react to the market slowing down. Sellers to react to the market slowing down. But eventually, as inventory begins to build, houses sit on the market a little bit, we'll see a moderation in price appreciation. I do not foresee us necessarily seeing a contraction in home prices because of the inventory situation that we talked about. However, there are certain markets and certain submarkets that actually may see prices decline. And so it's important that, people pay attention to those distinctions.
Mm-hmm. And then I actually have a question that I like to ask everybody, just to kind of really see what it's like doing what you do. What's the hardest part of your job that you have, are having to deal with?
So I would say, well, today it's working from home and dealing with the train.
That's funny.
in the background. I think it's really keeping track of how fast market conditions move. We have to always be aware of how things are changing. And a lot of times the data that we use, we get fresh data, but if it's a couple months behind, it could be behind where the current market conditions are. Mm-hmm. And so doing meetings like this and taking questions and talking to most people may not be aware, the Federal Reserve, every district has every FOMC cycle, we're talking to market participants, doing interviews and phone calls and meetings like this, just to figure out what's going on, because the qualitative data that we get from these conversations give us a leading indicator of where things are going, even better than the quantitative data that we get. And so it's a big job. It's very complicated. We miss things sometimes because the data sometimes is behind where the market trends are. But having these kind of conversations and doing outreach like this certainly helps.
Yeah, definitely. You can't capture everything, but it sounds like, from your presentation, you guys have a lot of really helpful information for everybody. Now, if people do want to get in contact with you, would you mind putting your information there in the chat box? Because I'm sure that there will be a lot of people that would like to reach out to you for anything that they may not have answered today. And this will, for everybody online, this will be recorded. You'll have the option to go back and rewatch it. But just as our final question, do you have any tips for those, getting ready to start investing? What's one piece of advice you would leave our audience with?
So as you can imagine, as an employee of the Federal Reserve, we can't give you, direct hints on where you should make investments. But what I will encourage everyone to do is just do your homework and examine market conditions and look at data and rely on those analysts and those people that are doing research, doing good analysis of market conditions before you make investments. The more you know, the more you can limit the potential risks you might be taking.
Absolutely. The more knowledge, the better.
Yeah.
Well, Domonic, I really do appreciate you joining us today. This has been a really great presentation. I'm sure we'll have you out again. But just as a reminder for everybody who has joined us today, if you're looking to get started with your self-directed IRA and move over those funds, we are offering our rewards for deposits promo this month, and you'll get a free toaster as well if you open your account. So again, thank you, Domonic. Thank you everyone for joining us today. Feel free to contact us at iraspecialists@questtrust.com. We'll put that in the chat as well. But if you have any questions, we're here to help. And be sure to join us this Saturday for our next webinar. Thank you, everyone.